Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and I'm here with Jesse Vandermeer and also Andrew Chang. And what a timely time to have our webcast number 6. There's a lot of things going on in the market, so we're excited that we're able to talk to you and present some ideas and some opportunities in terms of the current market. So there is a presentation that you can snap on that is below the screen, and also was sent out to you if you received the email from us. And we'll be working through that presentation. So the first thing I'll just note is we've entitled this Coronapanic or Coronaopportunity. And clearly the dominant theme in the marketplace right now is the coronavirus and the impact that's having on the equity markets and we're speaking strictly from an investment perspective. So we want to address that, but put it also in a larger context, and then talk about a couple of companies that we believe are great long-term investments, regardless of the current upheaval that we're seeing in the markets. So on the next slide, if you're just working through the slide 2, you'll see a disclaimer. And I'm going to go to the slides in just a few moments. And that's all of the legalese that's important for you to look at that we must put up there. And then on the third slide, we have the outline of the presentation. And so I'll talk just very briefly about our own company, our investment philosophy, the investment challenges, and then the key issues for 2020, which is where we're going to spend most of our time in terms of my portion of the presentation. And then our strategy and positioning, how we're approaching this in terms of the market. And then I'm going to hand it over to both Jesse and Andrew to talk about a couple of companies, Brookfield, Renewable, and then also CNR, Canadian National Railway, 2 very topical companies to be speaking about in the context of the current market. So on the next slide, and I'm just going to go to the slide presentation here right now, so just bear with me and I'll share the screen with you. And it should come up in just a second. Here we go. Let me forward to the next slide here. So just a quick overview of the company, just for perspective. We were founded 10 years ago. We just celebrated our 10th anniversary. We're assets under management of about 155 million, depending on the volatility of the market. And we're about 135 households now that we manage money for. And we build customized portfolios. And this is really our expertise, and our focus is to make sure that we're building portfolios that meet your needs and they're customized to your objectives. And then we've got a couple of things there in terms of independent thinking, understanding the investments. You're going to hear about a couple today. And then understanding the current realities and trying to adjust our investments accordingly. And then on the next slide, we just remind you again of we want to buy great companies. And so even in this market upheaval, we're in the kind of companies that have staying power. They're built to last. And they're also built to take advantage in opportunities that always emerge whenever there's a washout in the marketplace. I've been doing this for 30 years, and these become exciting times to actually build great positions, stay in great positions, and seek opportunities in the marketplace, which really position us for the next long-term period of growth. And so here's just a couple of things about our investment philosophy. I'm not going to go through that, because most of you are aware of it and you can read that on your own. And you, I know, want us to get into sort of our strategy as it's pertains to the current marketplace. So the investment challenges, as we've talked about before, excessive global debt. And this is one of the challenges that we see with this coronavirus. It's come upon us, the global economy, if you will, at a time of tremendous debt load. And that just sort of stresses the whole global environment even more. Unfunded government promises are an ongoing problem. Governments have made all sorts of promises that are going to be difficult to keep, which put financial stress on the market. Demographics, the aging populations all around the world, and lack of family formation. This is a major, major problem, especially if you're going to fund pensions and retirements and so on. And then the monetary policies, which we'll get back to in a second, printing money and record low and even negative interest rates. In the last 3 weeks, we've seen the central banks printing more money. We just had an announcement today from the European Central Bank that they're going to be printing not just 20 billion euros a month, they're going to increase it to 120 billion euros a month. Just go into the market and buy up assets, buy up securities with that money. And also the interest rates in Canada and United States have plummeted the last 3 weeks. We've got, and I have a couple slides I'll talk about. So these are major issues. It's showing that there's financial stress in the system. This shouldn't surprise us because of all the debt. And then we've got this coronavirus, or the COVID-19, and we need to speak about that because that's becoming a dominant issue in the marketplace. So the key issues for 2020, which I'm going to just have a slide in each of these and just address them quickly. Stock market valuations. We have a number of clients, and I think this is great thinking, when clients phone me up or they email me, and we've probably had 10 of them in the last couple of days, say, are there opportunities? Should we be buying more? And so I want to talk a little bit about current stock market valuations, put that in perspective. Record levels of debt, just to remind you of how big that pile of debt really is. Just to remind you again of the record low interest rates, which are, again, an indication of stress. This is not a positive thing when you have interest rates that are negative or basically just a little above zero. It's telling you we need to be careful. We need to be patient. We need to be alert. We need to be on our guard. We need to be careful of the kind of securities that we're buying. And then high levels of market volatility. That's when you see high levels of swings in the market. Prices are changing very rapidly. I've got a slide and I'll talk a little bit about that in a second. In fact, when we see a lot of market volatility, this is actually a good thing because it means that there's a washout in the marketplace. It's getting stocks into stronger hands, not weaker hands. And then the coronavirus, I'm going to talk specifically about that. So in terms of stock market valuations, on the slide in front of you, you can see that, what is this? Well, it goes way back and it shows that we're looking at the S&P 500. We're using this as a proxy to the market. Why do we use the S&P 500? Well, it's the 500 largest, stocks in the United States that trade on the market, and they typically are global, and it's a great representative basket. So when you look at this, you can see that currently, when this slide was produced just 2 weeks ago, not very long ago, stocks were trading about 24 times earnings. That would be sort of the trailing earnings that were estimated. And typically, if you go back, you can see different peaks, 25, 22, different peaks along there. Then you can see you typically have a bit of a downstroke after that. Now, if you go back and you look at that 123, that's on your far right, under 2010, that was during the financial crisis where earnings just disappeared. And so therefore, if you have a fraction and your denominator becomes very small, then the number is going to become very large if your numerator it stays reasonably the same. And so what you've had a large spike in that PE ratio just simply because earnings collapsed there during the financial crisis. So on the next slide, I just talk a little bit about, put this in perspective. So currently, the March earnings are estimated to be about $139 across the S&P 500, and we'll take that for the estimate as it is. And as of March 9th, this was earlier this week, we're still trading at a PE ratio of about 20. As of today, I just updated that number. We're about 18 times earnings, and that's with no adjustment to earnings. And the average over the long term typically is, about 16 times, and that's when you're talking about solid earnings. So what we're trying to point out here is, look, earnings are going to be under pressure because we've got this massive change in the structure of our economy as we quarantine people, as we stop certain movement of people around the world. This is going to impact earnings. And so if earnings are going to be impacted and we're still trading well above our averages, we want to be careful in terms of valuations. Our conclusion is, look, we still have more downside. We could still have another 5 or 10% downside and then a settling out period where there could be some wonderful opportunities to buy stocks. And so again, we are focused on valuations. If we're going to step in, we want to make sure we're getting great bargains and not catching a falling knife. So we're going to be very careful and patient. So that's just a quick update on stock market valuations. Yes, they've come down, but they're still not super cheap. We're seeing some things emerge today in the market that are getting us a little bit more excited, no question about it. And so I think over the next couple of days, couple of weeks, even next month, there's going to be some wonderful opportunities emerging. In terms of global, debt levels, I put this slide up here just to remind you that after the debt crisis of 2009, all we did was put on more debt. And we live in Canada, so we know about debt. We have a federal government that's committed to piling debt on through the good days and bad days. And so we know what that's like. We also have Canadians that are some of the most indebted in terms of the, and if you look around the world in terms of a society or culture. So we put this up because we say that, look, when this coronavirus hits, and we've already got stresses on the global economy, we've got an aging population, and we got record levels of debt. This means we've got to be very careful. It's not going to be easy getting out of this problem, and so we need to be patient in targeting certain companies. Record low interest rates, we've talked about this for the last 8 years. In fact, I've talked about it the last 6-7 years in detail, probably more detail than you really wanted to hear from me. But as most people know, in Europe, we've actually got negative rates. You buy a 10-year bond in Switzerland, in France, in Germany, in the Netherlands, they're all negative yields. But look, this slide's pointing just at the US Treasury. And we look at the US market because, as most of you know, the US dollar is the reserve currency of the world. And so what happens with US Treasuries is really the most important thing to be looking at in terms of bonds. And last couple of days, the whole Treasury yield curve, that means from 1 year to 30 years, actually went below 1%. Now, in the last couple of days, the 30-year bond has gone back up again above 1%, but the 10-year Treasury, 5-year Treasury, 2-year Treasury, and so forth are all sub 1%. And in Canada, our 10-year is around 50 or 60 basis points, so 0.5 to 0.6%. This is showing, again, a massive amount of stress in the system. And you can see that precipitous drop there right at the end. And so, again, this record low rates, it's telling us, be careful. This is going to make it difficult for funding and for credit. The credit markets are under stress, basically. And so we expect more interaction with the central banks. This is the level of VIX. Now, some of this might get technical for people, and I don't want it to be technical. What I want to emphasize is that the VIX measures volatility, the changes of prices and how volatile they are. And whenever you get into a period of stress or whenever you get into a downturn, the market gets concerned, of course, price volatility increases. I don't have to tell you that, because if you're following the markets, you're going, wow, I'm seeing this every day. What's going on here? Up 1,000, down 1,000, up 1,000, down 2,000, and so on. But it's also important to point out that when we see the market volatility, or we look at the VIX index, it tells us there's a washout. It tells us that stocks are trading hands furiously, which is good, because whenever there's a seller, there's a buyer. And when that person buying is typically, should be wiser and more disciplined than the person selling at that point. And so when you look at this, if you go back to 2008, you can see where it really spiked up. 2008, 2009, the VIX reached a level of about 79, 80 at its highest. This was when we were really in the bottom of the credit crisis. And recently, we've seen the VIX north of 50, and you can see that on the far right-hand side. That takes us just up to really last week, just when this chart was created. And today we're at 66. So we're really running a high level of volatility. We need to run a high level of volatility for some time, and maybe a number of weeks or maybe a couple months. And that means that we're really cleaning the system up. We like that. And we're excited to see the VIX up high, and that's because it's going to provide us with opportunities at the end of the day. That's what happens when I think it was Rothschild. Rothschild many years ago said, "When there's blood in the streets, that's when you invest." And it's a rather picturesque way of saying it, but when there's panic, that's when you want to be really sharpening your pencil and looking at opportunities. Now, the coronavirus. I'm not going to speak about this medically. That's not our intent. Is to look at it just from an investment perspective. It's a virus, as we all know. It's spreading quickly and it's global. It's actually been named, a pandemic by the World Health Organization. One of the problems with it is it seems to be easily spread. Mortality rates are higher than flu-type viruses, other flu-type viruses, other influenza issues, which typically are maybe 0.1%, 0.2%. This appears to be maybe around 1%. I mean, there's all different numbers, but Best we're getting now, if you're in a stable, reasonable country, it's running around, say, 1%. But that's 10 times more than the average flu virus. So it's concerning. The other thing is it really hits people that are older. I've got 50 years of age or up, but it's really more like 70 and up. The average age of the person that has passed away in the United States is 80. So it's really hitting people that are older or compromised from an immunology perspective in terms of their immune system. The problem is that medical treatments are at least 2 to 3 months away, and those would be viral treatments, and any kind of potential vaccines at least 12 months away in terms of getting it to market. And so the virus itself obviously is concerning, but it's the response to the virus that we're watching, and what kind of impact the response to this virus is going to have on earnings and on companies and on businesses and on, therefore, the stock market. That's what our focus is as investment professionals. Other than keeping our hands clean and being very careful ourselves, our focus is, again, what's going to happen to earnings, and are there opportunities that are going to emerge in the marketplace? Okay, these containment strategies are really choking the supply chains around the world, and they're exposing the significant vulnerabilities we have to the sort of the cult of globalism. We've had this, worshiping at the feet of globalism, that was going to solve all our problems. Well, the problem with that is that globalism doesn't solve all our problems. It introduces other problems, including that we're dependent on other nations, and some of those nations are less than honorable, less than trustworthy, and we're seeing this exposed. And so this supply chain, the shortages, cutting off countries in terms of travel, which we saw last night with President Trump, these are going to impact companies. It's going to impact earnings. It's already impacting earnings. And so if we're going to have falling earnings in the midst of a panicked situation, this is going to create lower stock prices, and lower stock prices are going to give us opportunities. So on this slide, next slide, I just mentioned that the global economic growth is definitely going to be reduced for at least the next 2 quarters. I mean, I can't make, we don't make long-term predictions in terms of something that we're not confident about, but you just look at what's happening in terms of businesses and how they're radically having to overhaul what they're doing in the travel industry and so on. This will put downward pressure on earnings and therefore stock prices. And that's why the stock market has been hit so hard. Aside from, also, we don't even talk about it here, the oil industry, which has been brutally broadsided by the competitive pressures between Russia and also Saudi Arabia, which is another exacerbation of the drop in stock prices, especially here in Canada, where we're exposed to the oil industry. But the long and short of it is there's pressure, and it's not going away anytime soon. So what does this mean? Central banks are definitely escalating the expansion of the money supply, which we already talked about. I expect next week the Federal Reserve will be, or maybe even sooner, they might make an announcement. They've already cut rates and put more money into the system. They're already supporting the some of the current market. They call it the repo market. They're already been adding a lot of funds to that market now for a number of months. This will put, again, downward pressure on interest rates, certainly keep them low where they're at. And so this is going to, again, provide opportunity. So this corona panic has definitely set in. I don't have to tell you that it's set in. And we've seen a 25% drop in the market if you're looking at the broader indexes. And so what we're looking at is, okay, this definitely is having an impact on companies, on earnings, the stock market, people's psyche, people's confidence. This means values are going to emerge. They are emerging, and they're going to continue to emerge for the next little while. So our view is, look, we want to be careful. We need to be patient. And in the interim, we need to be very vigilant and focused to make sure we own the kind of companies that have staying power, that can actually take advantage of this down period by making great investments, buying back their own stock, buying up weak competitors. There's all sorts of things that companies can do. And those are the kind of companies that we want to own. So what's our strategy in a nutshell? And I'm summarizing, there's much more I could say, but let me just mention these quickly. First of all, we minimize exposure to financial institutions. We have very little exposure to big banks. We have about 3% of our client assets actually in it's like TD Bank, and we have a couple little positions in a couple of other Canadian banks. Very little across our business, and we've done this purposely long before the coronavirus because we don't like the leverage in the global financial system. There's too much leverage. And with the coronavirus, now the banks are even more exposed to eroding credit markets, pressure from their clients, bad loans, And then now with interest rates going down so much, their interest spread margins are under severe pressure. So we're glad we have very little exposure to banks, especially if they were global banks. I mean, if you get over to Europe, those banks are a disaster, and most of them are already insolvent. So we have very little exposure there. We'll continue to minimize exposure to highly leveraged financial institutions. We minimize exposure to economically sensitive commodities. If you have a weak economy, you don't want economically sensitive commodities. And that could be anything from, nickel, some of the base metals, to oil. We've never been big players in the oil market, and you can be happy about that because the oil market, especially these Toronto companies, have been pummeled, absolutely pummeled. And again, our exposure there is like low single digits. And so that's been very positive, and that's helped us in this environment. Really, it's helped us for the last 5 years with the bad oil market. We minimize exposure to consumer discretionary businesses. That means businesses where they might be, travel businesses, retail businesses where people can easily pull back their spending. And we prefer consumer staples, the kind of stuff you have to buy. Otherwise, you won't be alive very long. You need these businesses, food staples and things like that. We also maintain healthy exposure to precious metals. Gold, silver as a partial hedge to low interest rates and money printing and excessive debt levels. So that we own some great, royalty companies in the precious metals. Now, these have been volatile the last couple of days, more volatile than I think they should be or normally would be. But again, we're getting liquidation. We're getting people selling things. They're on margin calls. They're in passive investments, ETFs, and things just get sold indiscriminately. That's why we've got your portfolios, your companies in your own accounts. You own these securities directly. We don't get pushed around by the market. We don't get pushed into selling something because you're in a fund with someone else that wants to sell. Forget that. And so we help minimize your risk, and we can hang in there, and we can hold great assets, and we don't get caught in liquidation periods. On the next page there, we maintain significant investments outside of Canada as a hedge against our weak dollar and low oil prices. This has been important the last couple of weeks because our dollar has really come down. I mean, we have probably one of the most inept governments within certainly the G7, G8. It's a very, very poorly managed government, very incompetent in terms of our federal government. And so we're not overly thrilled about what they're doing, their policies, their economic policies, their fiscal policies, their debt that they've been whacking up. But then you put on top of that low oil prices, and you put a country that cannot really it's very hard to buttress itself against these low oil prices, which are about 9-10% of our GDP, and have been under attack by our government and a lot of politicians anyway. And our dollar is, in our view, could easily go below 70 cents. And so we have a lot of investments outside of Canada that gives you a good hedge. We maintain equity investments in core businesses with strong balance sheets that are essential to the economy with substantial moats. And we've talked about that. We're going to talk about a couple of those today. In precious metals, in healthcare, in infrastructure, technology, basic businesses, consumer staples, and so on. These are the industries we want to be in. Maintain liquidity, including a healthy cash balance. Most of across our business, we have about 30% in cash. That's going to vary again by client and with clients' wishes, but that's a great buffer and it gives us firepower. We're not going to be a Coronapanic. We're not going to, panic in this marketplace. I've done this for 30 years, and we know that we've got to stay focused and be disciplined and vigilant and know what we want to own, and we be patient, and the Coronaopportunity is definitely coming our way. There's a quick slide here just at the end of February. The performance has held up quite well across our complex, if you will. We'll see what happens today, but I was just looking at the numbers. This is our book of business. This would be across both equities and bonds. But as of last night, across our whole book of business, we were down by about 3.5% to 4% since the beginning of the year. And that's against indexes that are off about 17%. Now, today is a bad day and things will be volatile and so forth. But if we can fall and go down, a third of what the market goes down or half of the market and better, and then come ripping right back, then that's the kind of way that we like to be positioned in the marketplace and not get pummeled all the way down and go down even worse in the market, which is what's happening, I think, in a lot of fund complexes. So we're pleased with how we're holding up, and we're focused on how we work ourselves out of this and position for the long term. So I'm going to hand it over to Jesse, and he's going to talk about Brookfield Renewable Partners, and then the Canadian National Railway, Andrew will talk about after Jesse's finished. So over to Jesse to pick up and talk about that.
Thank you, Jonathan. Like Jonathan mentioned, I will be talking about Brookfield Renewable Partners. It's one of our largest holdings and also flies under the flagship name Brookfield, under its parent company, Brookfield Asset Management. Brookfield Renewable Partners is a publicly listed partnership, and they are one of the world's largest operators and owners of renewable power assets. They have $50 billion of assets under management, around 3,000 operating employees, and they operate in 17 countries with 19,000 megawatts of capacity. On the slide, the first slide there, you'll see the breakdown by technology. They have a large portion, just over 3/4, in hydro assets. Hydro assets are great because they serve as a mini monopoly on the majority of river systems, and a lot of these cash flows are contracted. They do have some growing presence in wind and solar. Wind and solar are easier to build out more quickly, and they're doing so especially in foreign markets now. In terms of those markets, it is predominantly North America. However, they are having a growing presence in Asia and Europe. Brookfield has a long history of operating in Latin America, so they do have a sizable presence in Brazil and Colombia. And like I said, the contracted cash flows count for the vast majority of their revenue profile, which is great. In days like today in the market, we see, the prices go up and down, but understand that the underlying revenue profile and the economics of the business, they're not trading like that. The vast majority of these cash flows are contracted. Moving on to the next slide, I'll actually pull that up onto the screen, and you'll be able to see the global presence in this map. As you see there, you have this large map here, and you can see the breakdown by assets in each of the countries. Brookfield has put $3.5 billion of equity to work in the past 5 years across organic and inorganic opportunities, or rather put plainly, in acquisitions or of their own development. That's $3.5 billion of equity. So in terms of enterprise value, so that includes equity and debt. In terms of acquisitions, it's more like tens of billions. So with 50 billion of assets under management, they are one of the world's largest operators of renewable assets. Now, in terms of why Brookfield is such a large holding, the vast majority of clients do own it. Firstly, it has great contracted cash flows, like I said. These are stable cash flows, largely hedged against inflation and currency fluctuations, which again, with a stable revenue profile, they are able to pay out quite a healthy dividend. So it serves as a great income producing security in a lot of clients' portfolios. Again, with the interest rates falling precipitously in the markets, lower interest rates increase the value of these stable cash flows, which over the long term, with lower interest rates, Brookfield Renewables security and equity should increase in value. That's just the basic present value formula. And again, with Brookfield, because they are one of the largest operators of renewable assets, they have diversity squared. So by that, they are global. So they have geographic diversification, which is great because they are affected by different vagaries and weather systems, different trends and patterns in rainfall all around the world, or wind generation, or what have you. So they are able to benefit from that diversification, and then also technological diversification. So hydro, solar, wind, and they are getting into pumped storage and other storage opportunities. Second, a big main point is decarbonization. As we know, renewable assets are certainly popular. 45% of the capacity right now in Europe and North America in terms of power is actually still coal and gas. In the past 5 years, $1.5 trillion has been invested in new renewables. So there's a lot of money going into the space. There's a lot of opportunity for renewable companies like Brookfield. A lot of countries and companies are interested with building out their renewable capacity. And then I also highlight 3 main drivers of this growth, all flowing under decarbonization. So we have ESG and passive inflows. I don't have to tell you about the interest from university endowments to governments and many of individual shareholders in terms of in the environment, bringing offline coal plants and so forth. There's a lot of interest in investing in these environmentally sensitive companies. The competitive cost structure over the years and decades, these costs of renewable power have come down precipitously. It is on par with oil and gas, and in some places, in a lot of places actually, is more cost competitive than these traditional carbonized sources of energy. And then also we see government mandates, especially in Europe, but we now see them in Canada and other places around the world, even places like Japan, which has historically relied on nuclear power. We see these governments and countries become very, very interested in building out their renewable capacity generation. So that's one big driver of the business. And this is a future-proof business. These trends are going to go on for years and years, and Brookfield is well positioned to take advantage of this. Brookfield itself, like I said, it does have global reach. It has the operational expertise. It may buy up a renewable power company and actually implement within its management Brookfield employees. So they're able to streamline the business and seek out efficiencies where possible, which drive value. Brookfield's size and access to capital are good levers to pull. They are able to complete transactions or invest in new projects, which many smaller companies may not be able to. So that gives them a key competitive advantage there. And then lastly, Brookfield's asset recycling. This is a Brookfield quality and highlight the management across the Brookfield companies. They take advantage of asset recycling, which means basically they just sell assets where they see that they can get a very good value for and take the proceeds and then buy other assets or wait or until they can buy other assets at really good prices. So this drives value up over the long term. Quickly on this slide, you see the return distribution. So they target 12 to 15% in total returns. 10% comes from cash flow growth, and 5% comes from the distribution or dividend yield, resulting in a 15% total return. So we'll actually start from backwards to frontwards, starting with acquisitions. Yearly, they seek 3 to 5% from acquisitions. Again, they're very adept at acquiring companies, particularly those in trouble, or larger companies where many businesses wouldn't be able to perform or execute on the transaction. And then they strive to see 3 to 5% from development and repowering. So either this is newer technologies or efficiencies where they're able to execute on, or their own organic opportunities, meaning they build from the ground up in a new area. And then 2 to 4% from margin enhancement. They can really drive value from their historical expertise of running power generation assets. They know how to recontract. They know how to deal with authorities to build out new areas. They have a lot of expertise in this, so they can actually drive and squeeze value from existing assets. And then lastly, like I said before, 1 to 2% from inflation escalation. These are escalators embedded in these contracts where they're able to increase prices 1 to 2% year over year. So with these levers to pull, they're able to strive for a 15% total return. And then lastly, on this last slide, you can see that from the late 90s, from 1999 to the end of 2018, they've had a 16% total return. So that's in line with Their stated targeted returns of 12 to 15%. So Brookfield remains one of our top holdings. It's very high quality. It's a future-proof business, you could say, with its focus and adept expertise on operating and developing these renewable assets. I'll now turn it over to Andrew, and he'll talk about CN.
That's great. Thanks so much, Jesse. As mentioned, the company that I will be discussing today is the Canadian National Railway, or CN for short. In my presentation, I'll briefly go over an overview of the company, and next I'll walk through the competitive dynamics of the railway industry. And then lastly, I'll discuss the fundamentals that make us attracted to CN as a long-term investment. So CN has a rich 100-year history in shaping and transforming and growing the North American economy. Now, it would not be a far stretch for me to say that CN is a company that moves the economy, literally. The railway companies such as CN provide the fundamental backbone infrastructure of the North American economy and is an efficient means of transporting goods throughout the country. They are so vital to the economy and is an enabler of transport and exports of goods. On the slide there, what I will show you is CN's vast network, rail network that spans 19,600 miles, starting in Prince Rupert on the Pacific coast, all the way to Halifax, downwards towards the United States, to the Gulf of Mexico. CN is the only railway that's able to connect all three coasts, giving it a geographic competitive advantage. Now, CN is more than just a railway. It has a complementary trucking operations as well. It is one of Canada's largest full-load trucking operators, with over 1,050 trucking owner and operators located along its network. Now, this is very beneficial because it helps extend its capacity and able to reach 75% of the North American population. It also gives its customers flexibility in different transportation modes. From rail to road to water, CN has an efficient fleet of vessels that's equipped to transport goods and commodities along trade routes. It has some of the most sought-after exclusive ports, such as the Prince Rupert port and also the port of Halifax. Customers are able to benefit from CN's vast network of transportation means, and they're able to transport their goods not just on railway, but in between rail, road, and water through its intermodal terminals. And this gives CN further flexibility and really makes it more than just an infrastructure company, but really a vital supply chain partner to many of its customers that count on CN to transport its goods to customers like you and myself. On the next two slides, you'll see that CN has a diversified portfolio of commodities and goods that it transports. Now, I won't cover off each item. I'll let you look at it on your own leisure, but I will focus on one of its items that it ships, which accounts for 20% of its business, which is the petroleum and chemicals. And this includes crude oil, natural gas liquids, refined petroleum products, sulfur, and a diverse range of chemicals and plastics. Now, this business has actually been increasing over the past few years, and this has been due to a lack of pipeline access to the US Gulf Coast and a lack of access across Canada. And so because of this lack of pipeline access to transport crude oil producers have been increasingly reliant on railway companies such as CN to transport its crude. Now, this is not the most efficient way of transporting, nor is it a sustainable means, but this has been a benefit for CN. Next, I'm just going to walk through very quickly just the dynamics of the railroad industry. Now, CN competes with a concentrated number of Class 1 railroads. Now, Class 1 railroads are railroads that generate operating revenue of $450 million and above. Now, there's only 7 major railroads that actually meet this classification. In Canada, we have a duopoly. CN and CP, Canadian Pacific Railway, or CPR, are the only railways in Canada. There are 5 railways in the US, which is the Burlington Northern Santa Fe, which is owned by Berkshire Hathaway. We also have CSX Transportation, Kansas City Southern, Norfolk Southern, and Union Pacific. So we have a limited number of competitors, which owns a majority share of the rail business. Now, as I mentioned before, the railway business is the fundamental backbone of the North American economy, and it's a critical enabler of trade. Now, railroads account for approximately 1/3 of US exports by volume and approximately half of Canada's exports. Now, that's a significant portion of moving the North American economy. And we see the slowdown in GDP that can occur when there is something like a blockade that we've been recently seeing. It really does halt the economy. And as you can see, that is very vital to the growth and the sustainability of goods being transported throughout the economy. The railroad industry is also an efficient means of transporting goods. Now, on average, rail is 4 times more efficient per gallon of fuel than trucks. The average US freight rail can move 1 ton of freight over 470 miles per gallon on fuel. That's about 200 kilometers per 1 liter of fuel. Now, as a customer of CN, you can see why this is a very attractive partner to go towards. If you can be able to cut down on one of your most highest costs, which is gasoline, which is fuel, you'll definitely want to go to CN as opposed to a trucking operations to transport your goods. Lastly, the railroad industry has high barriers on market entry. And what that means is that it's very difficult for new entrants to be able to enter into the railroad industry with increasing regulation and significant amount of capital that is required to replicate this existing operations. Is virtually impossible for a new player to come in. So with these dynamics of having an oligopolistic market with very difficult constraints to be able to enter into this market and to be such an important part of customers' supply chain, you can see why this is undoubtedly a very important industry of the economy. Now, on the next slide, I'm just going to discuss why we think that CN in particular of these railroads is an attractive long-term investment. CN has an unrivaled rail network that is strategically located across 3 North American coasts. And as I mentioned before, CN is the only railway operator that actually is able to connect across those 3 coasts. Now, since becoming private in 1995, now before that, CN was actually owned and operated by the government, which is a very inefficient means of operating a railway. They've made some very strategic capital allocations, very good at deploying capital, expanding its network in very highly coveted ports and hubs. And one example is their investments that they've made in Chicago, which is a very important hub within the United States. And they were able to make investments in that area to be able to reduce bottlenecks in the area, to be able to transport their goods more efficiently through that area, which is very important. Next, CN is an exceptionally efficient railroad operator. Now, they are one of the early pioneers of the precision scheduled railroading method, and that was developed by the late Hunter Harrison. And they have been very good at being able to cut costs, be able to transport goods while maintaining a lot less capital and less costs. And that's been able to help them reduce their operating ratios, which is the ratio of your expense to your revenues. And they've been able to reduce that down to 62.5%. And this is one of the best in the industry. And actually, a lot of its competitors have actually copied this method. And if you look at their competitor operating ratios over time, their operating ratios have actually lowered as well. And it's been very beneficial by applying the precision scheduled railroading method. Next, CN is a very prudent allocator of capital. It focuses on growth while maintaining a healthy financial position. So over the years, CN has been very prudent at reinvesting its free cash flow in high return projects. And they've been able to grow their dividend while maintaining healthy debt levels. So for example, the return on invested capital, which is the return that they get on the capital that they invest, has been above 15%. And that's been higher than their cost of capital, which has ranged about 6 to 8% over the years. They've been able to grow their dividend at a compound annual growth rate above 15%. And this has been very beneficial to our investors, as dividend plays an important income generator in your portfolios. And all the while being able to maintain a low debt to equity ratio of less than 1. And so you can see that this has been one of the attractive features of CN, and they've continued to deploy their capital in very smart areas. And lastly, CN has a diversified portfolio business and customer base, and we like to see that because we don't want a company that's exposed to just one or a small number of sectors. As you can see, if one sector is severely hit, that really does it can really impact a company's net income that they can generate quite significantly. So by having a diversified portfolio, this is very beneficial in difficult times that come. Now, lastly, how does this all translate to stock performance? I have here, just for us, a stock chart from January 4th, 2010 to March 6th. So if you had invested $10,000 and reinvested those dividends that CN gives, the distributes to the shareholders, from January 4th, 2010 to March 6th, 2020, you would have $47,968.26. Now you can see that being in an oligopolistic market, as a leading railroad operator, very efficient with a diversified portfolio of commodities and goods that it's able to transport, to be very efficient and to allocate its free cash flow in very smart strategic areas. You can see why CN has been a very good performer, over 4.5 times your money over that period. And this is why we think, and we continue to believe, that CN will be a very important and pertinent contributor to the growth of our clients' portfolios. So now I'm going to transfer over to Jonathan for a Q&A.
Thank you very much, Andrew. And hopefully, again, just going through a couple of the companies that we have in many of your portfolios, it gives you a sense of the strength, the integrity of these companies and their long-term positioning, so that, you know, you get these ups and downs in the market, you get all sorts of challenges. Now it's the coronavirus, and tomorrow will be something else. But these are core staples, they're core parts of our business and parts of the economy. So a couple of questions that quickly came in from the internet that I'll just answer very quickly. Number one, Canadian dollar, where's that going to go? I did mention a little bit about the Canadian dollar. Look, as long as commodities are under pressure, regardless of our leadership in this country who thinks somehow that we can run Canada without, you know, a strong commodity sector, that's just not the case, certainly not for the next 10 to 15 years anyway, at least. As long as commodities are under pressure, it's going to put pressure on our dollar. And so we want to be careful. You know, Canada, you know, is filled with tremendous companies and businesses and resilient people, but there's just a lot of pressure on our dollar to go down. If you've got oil prices, really in the tank, you've got other base metals and other productive commodities that are important for us in the tank, and you've also got a federal government that's running record deficits. So the deficit in Canada over the next year, I hate to think how high it's going to go. I mean, we were promised 10 billion at the max, and then it would all be gone by 2019, and we've been running deficits just close to 30 billion. And so the estimate, this is the estimate from the government over the next 4 years, is we're going to add another 100 billion. And if that's their estimate, and we're in a weak environment like we're in now, I think we'll blow through those numbers, and that'll put pressure clearly on our dollar. So we want to be careful. Predicting currencies is a difficult business, and so we hedge by buying great companies making money in many different jurisdictions around the world. But I would not be surprised to see a sub $70. And the other question we had was just about precious metals. Someone asked us, do you recommend holding physical gold or silver, and what percentage would you own, and so forth. And what I would say is we do have a number of clients who own physical. They often do that on their own, though. They don't need to have us. We want to know what you own in physical, but they don't need to buy it through us. And if they are committed to a longer term positioning, I would recommend anywhere 4 or 5% in physical. If they feel comfortable, and you can buy that through all different places, and then you can hold that in safety deposit boxes, or you can hide it under your mattress if you want. But that's one area to keep a little bit there if you feel comfortable, and that's, you have tremendous concerns about the monetary system. And then for us, we maintain approximately 15 to 20% of your equity exposure in precious metals companies. And these are largely in the royalty companies, the finance companies. And we do that because we are very concerned about the monetary conditions. Just while Andrew and Jesse were talking, I heard that the Federal Reserve, just live, is adding another $4 trillion to the system, and through the repo market. And so again, we've got liquidity issues. We got a lot of pressure on our monetary system, and therefore having great businesses that can make more and more money off of the backs of precious metals, which are basically great ways to protect your purchasing power, makes total sense to us. And that's why we own the Francos in Nevada, Wheaton Precious Metals, Sandstorm, Royal Gold. There's a number of companies that fall into that mix, and we love these companies. So that answers the two questions there. Now, I just want to pull the guys back quickly, because with all this market turbulence, I'll speak to Andrew here first, and then Jesse. Andrew, maybe you can circle around behind me. I know it's not good for the picture there, but then Jesse can come along. Andrew, we're talking about all this market volatility, especially in some of the sectors you're looking at. Have you seen some really big changes and potentially some opportunities that we can take advantage of in the next, maybe the next month or two, as things get maybe a little more stable and more predictable in terms of the broader market?
Yeah, one thing I'm looking at, which is a contrarian view, would be one of the old online travel agencies, such as Booking Holdings. Yeah. And now this has taken a drastic hit over the past few weeks, not even months.
What was its peak?
About 2000.
This is Booking Holdings, so this is like Priceline.com. This is the bookings, the kayak, the online, the table for the restaurants, and so it's a huge system, but it's all about people traveling and moving around the world and going out. And if people are cocooning and hiding away, then they're going to feel the pressure. And so the stock's gone from, what's the high, about
2000 to now 1300.
Yeah, so from 2000 to 1300. But you got to realize they don't have a lot of fixed costs, and so they generate lots of cash, right?
Yeah. One of the things we like comparatively to the airlines or the cruises, it has very low fixed costs, and it has high operating leverage. Its operating margins about 35%. Whereas an airline would be just under 10%. I was looking at some of the cruises; they're about 13%. So 35% operating margin. They've generated free cash flow 9-year CAGR about over 20%.
And when Andrew mentions CAGR, that's cumulative average, compound average growth rate over the year. So he's talking 20%. It's 20% per year compounded, which is pretty dramatic.
Yeah, and these are great websites to go to if you're thinking of traveling. I think most of us, if you're going to look for a place in Italy or wherever you want to travel, you would be going on something like a bookings
Yeah.
and looking for hotels, looking for good deals. To book travel.
So this shellacking in the marketplace is going to potentially open up some really interesting opportunities in that space. That's the kind of business we look for, which is more lower capital, higher cash flow, and much more predictable. And it's not going out of business. And that's for sure. And they don't have all these big cap expenses. So that's an example. I mean, 2,000 down to, what was the low?
About 1,300.
1,300.
now,
So,
yeah.
700 drop on 2,000. I have to tell you, it's 35%. That's a big drop, and so on. So, Jesse, just quickly, the same question to you. I mean, we're looking at this marketplace and we're going, whoa. A couple of companies just mentioned, maybe one that we've been looking at, but it's just been too expensive. But boy, it's getting into range. And
Sure. Yeah. One of them is Moodys Corporation. They're a credit rating agency. So they give the ratings on all the debt that corporations issue. They have one or two other business lines. They have Moodys Analytics. So as you're aware, the ESG ratings that a lot of companies, corporations, endowments, pension funds, etc., that they now have to really incorporate into their business. Moodys provides a lot of those analytics and scorecards and services that really help these entities understand where they fall along these lines. So they offer two key services and products in today's investment universe. And with lower interest rates, the debt portion of the capital structure becomes even more interesting. Except for a major dislocation, the debt, as we've seen over the past 10 years, has exponential. So a rating agency like Moodys really benefits from that.
Yeah. So what happens with a company like Moodys, they're in the debt markets, they're in analytics, providing services to pension funds, endowments, all these big pockets of cash. And with the a market correction like this or a market slowdown, all of a sudden people sit on their hands. So they're not issuing debt as much, and they sit on their hands, and therefore they don't make as much in terms of transaction fees. And the market will really bounce them around. They'll put a premium price when things are going well, and then they'll just discount them in a significant way. So what's the recent high on Moodys? Just 3 weeks ago, maybe.
Yeah, so it was just a sliver under 300, and currently it's trading under 200. So they really push companies like Moodys and S&P, another interesting high quality name around. They really push them.
So here's a premier company that's dropped again about 33%. It's gone from 300, I should say, to 200. That's a third down. And so companies like that, they drop another $20, $30. They're going to be ones that we want to be targeting. So that's just giving a sense of what's happening in the market. Major swings, big swings. But we go into this knowing the kind of companies we want to own anyway, and we're not going to buy companies just based upon the coronavirus or what's impacted in the short run because of that. We want to buy great long-term businesses that are now being repriced favorably because of the current environment. So hopefully that's an update that you will benefit from in terms of the content. We know it's difficult. This is, in our view, not going to settle down in the next couple of hours, couple of weeks. It might take a couple of months. This too will pass. It is a serious situation, but we are riveted on opportunities and the things that we can control and control our behavior. And you can be rest assured that you own a basket of very strong companies, and you own them, not someone else, and they're not in some pool or fund that's being influenced by quick sellers and like a lot of ETFs and a lot of these passive investments. They're really being exposed for the weaknesses that come up in this type of market, and we'll continue just to nibble away carefully in the near future. But we're being very careful, reserving our judgment to just be patient, vigilant, and get a good sense of what's going to be developing over the next week to next month, probably, in terms of really stepping in and taking advantage of this, unless there's some companies that just become shockingly cheap, and then we'll nibble away on those. So thank you very much for attending and listening to the webcast. Our next webcast is scheduled for June the 11th, and if there's great information that we can pass along, or the need to do one in the interim because of market volatility, we can jump on and we might do one in the interim. But officially, our next webcast is June 11th, of course, in this year, 2020. Thank you very much. We appreciate your support. If you want more information on ROCKLINC and what we're doing, then you can call us, email us. Our website, ROCKLINC.com, and we'd love to speak to you, and we would love to be able to work along with you in terms of your investments. So thank you very much. Have a good rest of the day, and keep the seatbelt tightened, because it's going to be a little more rocky, and that's fine. That's where the opportunities emerge, and we're looking for them. Bye now.